your Mr. NPC, an educator at ClearIAS. UPSC Prelims 2022 exam is just over. Early comments from aspirants say that paper 1 was a little bit difficult and has more emphasis on history this year. For some, 7 questions were confusing, but for those who had revised most portions of the syllabus, the paper was easier. Set A of paper 1 was starting with economy related questions. The questions from economy section were slightly difficult compared to that of last year and answering most of which required conceptual clarity. In this video, we are providing the first part of the answer key along with detailed explanation. The official UPSC answer key may differ based on the various sources referred and differences in interpretations. Still, you can refer these answers for calculating your approximate scores. So, let's begin with the first 10 questions of set A of paper 1.
Question number 1. Rapid financing instrument and rapid credit facility are related to the provisions of lending by which one of the following? Option A, Asian Development Bank. Option B, International Monetary Fund. C, United Nations Environment Programme Finance Initiative. And option D, World Bank. To answer this question, you should know what are rapid financing instrument and rapid credit facility. The rapid financing instrument or RFI provides rapid financial assistance which is available to all member countries of International Monetary Fund facing an urgent balance of payment need. The rapid financing instrument was created as part of a broader reform to make the IMF's financial support more flexible to address the diverse needs of member countries. The RFI replaced the IMF's previous emergency assistance policy and can be used in a wide range of circumstances. Coming to the rapid credit facility, it provides rapid concessional financial assistance to low-income countries which are facing an urgent balance of payment need with no ex post conditionality, where a full-fledged economic program is neither necessary nor feasible. The RCF was created under the Poverty Reduction and Growth Trust as part of a broader reform to make the IMF's financial support more flexible and better tailored to the diverse needs of low-income countries, including in times of crisis. Therefore, Rapid Financial Instrument and Rapid Credit Facility are initiatives by International Monetary Fund. So, here the answer is option B, International Monetary Fund. Question number 2. With reference to Indian economy, consider the following statements. Statement number 1. An increase in nominal effective exchange rate indicates the appreciation of rupee. 2. An increase in the real effective exchange rate indicates an improvement in trade competitiveness. Statement 3. An increasing trend in domestic inflation related to inflation in other countries is likely to cause an increasing divergence between nominal effective exchange rate and real effective exchange rate. Before answering this question, we'll see what is nominal effective exchange rate and real effective exchange rate. The nominal effective exchange rate is an unadjusted weighted average rate at which one country's currency exchanges for a basket of multiple foreign currencies. The nominal exchange rate is the amount of domestic currency needed to purchase foreign currency. In economics, the nominal effective exchange rate is an indicator of a country's international competitiveness in terms of the foreign exchange market or forex. If a domestic currency increases against a basket of other currencies inside a floating exchange rate regime, nominal effective exchange rate is said to appreciate. If the domestic currency falls against the basket, the nominal effective exchange rate depreciates. Therefore, it's clear that the first statement in the question is right. That is, an increase in nominal effective exchange rate indicates appreciation of rupee. The real effective exchange rate is the weighted average of a country's currency in relation to an index or basket of other major currencies. The weights are determined by comparing the relative trade balance of a country's currency against that of each country in the index. An increase in a nation's real effective exchange rate is an indication that its exports are becoming more expensive and its imports are becoming cheaper. It is losing its trade competitiveness. And hence, the second statement is wrong. That is, an increase in the real effective exchange rate indicates an improvement in trade competitiveness is wrong, but it indicates losing its trade competitiveness. If you are sure about the first two statements or at least the second statement, then you can easily find out the answer without even reading the third statement. Here, we know that the second statement is wrong and therefore the option where 2 doesn't come will be the answer. Here, C is the only option where 2 is not there. Therefore, the answer has to be option C, 1 and 3 only. Question number 3. With reference to Indian economy, consider the following statements. Statement number 1. If the inflation is too high, Reserve Bank of India is likely to buy government securities. Statement number 2. If the rupee is rapidly depreciating, RBI is likely to sell dollars in the market. Statement 3. If interest rates in the USA or European Union were to fall, that is likely to induce RBI to buy dollars. We know that a central bank such as Reserve Bank of India periodically intervenes in the debt market to influence the interest rates and rate of inflation in the economy. If RBI feels inflation is too high, it will sell government securities because it has to suck money out of the system. Therefore, the first statement is wrong. That is, if the inflation is too high, Reserve Bank of India is likely to buy government securities. RBI will not be buying but selling the government securities. You will be able to answer this question if you know the first statement is wrong. 1 is there in all the options except B. Therefore, B has to be the right answer and statement 2 and 3 have to be right. With respect to the second statement, rupee depreciation means fall in value of rupee with respect to dollar. When the demand for dollar is more than the supply in free floating exchange rate regime, depreciation takes place. Thus, RBI is likely to sell dollars in the economy to increase the supply of the dollar. Therefore, statement 2 is correct. Coming to the third statement, if the interest rate in United States and European Union falls, there will be an inflow of dollars in the Indian market, which will lead to appreciation of the rupee. In order to reduce the supply of dollar in the economy, RBI will likely to buy the dollars from the market. Therefore, statement 3 is also correct. Hence, the answer is option B, 2 and 3 only. Question number 4. With reference to G20 Common Framework, consider the following statements. Statement number 1. It is an initiative endorsed by the G20 together with the Paris Club. 2. It is an initiative to support low-income countries with unsustainable debt. You need to find out the correct statements here. The Common Framework for Debt Treatment Beyond the DSSI or Debt Service Suspension Initiative, which is also called the Common Framework, is an initiative endorsed by the G20 together with the Paris Club in last November in order to support in a structural manner low-income countries with unsustainable debt. This common framework considers debt treatment on a case-by-case basis driven by requests from eligible debtor countries. In response to a request for debt treatment, a creditor committee is convened. Negotiations are supported by the IMF, the World Bank, including through their debt sustainability analysis. Therefore, here you can see that both the statements are right. Hence, the answer is option C, both 1 and 2. Question number 5. With reference to Indian economy, what are the advantages of inflation indexed bonds or IIBs? 1. Government can reduce the coupon rates on its borrowing by way of IIBs. 2. IIBs provide protection to the investors from uncertainty regarding inflation. 3. The interest received as well as capital gains on IIBs are not taxable. You have to find out the right statements here. Before that, you should know what are inflation-indexed bonds. These are government-issued bonds that guarantee a steady yield regardless of the amount of inflation in the economy. Inflation-indexed bonds are designed to provide a hedge and protect investors against macroeconomic risk in a given economy. IIBs provide a continuous return to investors regardless of the amount of inflation in the economy. The real coupon interest rates on IIB is fixed, but the nominal principal value is adjusted for inflation. Another benefit of IIBs is the stability of borrowing cost in real terms, as the real component of the coupon on IIB is fixed. Since the coupon rates are determined by current inflationary expectations, high inflation period remain very costly even when inflation declines and vice versa. Therefore, we can see that government can reduce the coupon rates on its borrowing by way of IIBs. Also, the central government has clarified that the interest on the inflation indexed bonds would clearly be taxable as interest income under the head income from other sources and note as capital gains, even though the entire amount is received on maturity. Therefore, here the first two statements are correct. That is, government can reduce the coupon rates on its borrowing by way of IABs, and IAB provide protection to the investors from uncertainty regarding inflation. And the third statement, that is, interest received as well as capital gains on IABs are not taxable, is wrong. And hence, the answer is option A, 1 and 2 only. Question number 6. With reference to foreign-owned e-commerce firms operating in India, which of the statements is or are correct? 1. They can sell their own goods in addition to offering their platforms as marketplaces. 2. The degree to which they can own big sellers on their platforms is limited. Here also, you need to select the correct answer. The Minister of Consumer Affairs has specified that any e-commerce marketplace entity shall not sell any goods owned by or controlled by it on such e-commerce marketplace platform. All the seller on the platform shall only be third-party sellers, and no e-commerce store can be run on the e-commerce marketplace platform. These changes come in the Consumer Protection E-Commerce Rules 2020, and the government has sought comments on it. Also, the degree to which foreign e-commerce companies can own big sellers on their platforms is limited to prevent those sellers acting covertly on their behalf. And therefore, the first statement is wrong because foreign e-commerce firms cannot sell their own goods in their e-commerce marketplaces. But statement 2 is right, as the degree to which they can own big sellers on their own platforms is limited. Hence, here the answer is option B, that is 2 only. Question number 7. Which of the following activities constitute real sector in the economy? 1. Farmers harvesting their crops. 2. Textile mills converting raw cotton into fabrics. 3. A commercial bank lending money to trading companies. And 4. A corporate body issuing rupee-denominated bonds overseas. Here also, you need to select the right answer using the codes given here. Real sector is the part of a country's economy that produces goods and services rather than the part that consists of financial services such as banks, stock markets, etc. It consists of enterprises or non-financial corporations, households, and non-profit institutions serving households. Non-financial organizations comprise all resident units involved in production of market goods and non-financial services. The real sector of the economy deals with the production side, while the nominal economy deals with the financial side. Financial activities mostly support the real sector but does not contribute itself too much except the factor income it generates. Coming to the activities given in the question, the first and second activities, that is, farmers harvesting their crops and textile mills converting raw cotton into fabrics, will come under real sector in the economy, whereas third and fourth cannot be considered as real sector activities in the economy. That is, a commercial bank lending money to trading company and a corporate body issuing rupee-denominated bonds overseas. And hence, the answer can be option A, that is 1 and 2 only. Question number 8. Which one of the following situations best reflects indirect transfers often talked about in media recently with reference to India? Option A. An Indian company investing in a foreign enterprise and paying taxes to the foreign country on the profits arising out of its investment. B. A foreign company investing in India and paying taxes to the country of its base on the profits arising out of its investment. C. An Indian company purchases tangible assets in a foreign country and sells such assets after their value increases and transfers the proceeds to India. And D. A foreign company transfers shares and such shares derive their substantial value from assets located in India. Indirect transfers refer to situations where when foreign entities own shares or assets in India, the shares of such foreign entities are transferred instead of a direct transfer of the underlying assets in India. Indirect transfer provisions deal with taxation of transactions wherein even though the transfer of shares took place overseas, the underlying assets were in India. And therefore, here the answer can be option D, that is, a foreign company transfers shares and such shares derive their substantial value from assets located in India. Question number 9. With reference to expenditure made by an organization or a company, which of the following statements is or are correct? Statement number 1. Acquiring new technology is capital expenditure. 2. Debt financing is considered capital expenditure, while equity financing is considered revenue expenditure. Select the correct answer using the code given below. The government's expenditure is categorized into two. One, the one which results in asset development or acquisition known as capital expenditure or capex, and that which is utilized to cover operating cost and obligations but does not result in asset creation, which is known as revenue expenditure. Capital expenditure or capex is defined by the union government as money spent on the acquisition of assets such as land, buildings, machinery, and equipment as well as stock investments. This includes investments that will produce earnings or dividends in the future, such as acquiring a new technology. It also includes the money given by the government in the form of loans to states or payment of its borrowings or debt financing. Whereas revenue expenditure is the expenditure by the government which does not impact its assets or liabilities. This includes salaries, interest payments, pension, and administrative expenses of the government. Equity financing is the process of raising capital through the sale of shares. Coming to the question again, we can see that the first statement and part of the second statement are correct, whereas the second part of the second statement is wrong because equity financing cannot be considered revenue expenditure. Hence, the answer is option A, 1 only. Question number 10. With reference to Indian economy, consider the following statements. 1. A share of the household financial savings goes towards government borrowings. 2. Dated securities issued at market-related rates in auctions form a large component of internal debt. Which of the following statements is or are correct? Household is the only segment that is the net financial surplus sector in the economy. All other segments, namely public sector, private sector, and general government, are in deficit. Deposits with banks are the single largest form of household's financial assets, which is followed by insurance funds, mutual funds, and currency. Therefore, any adverse movement in the household savings will have a significant bearing on banks, insurance companies, and mutual or provident funds, who in turn are key investors in government securities. Government debt can be broadly classified as internal debt and external debt. Internal debt is that part of the total debt that is owed to lenders within the country. It is the money the government borrows from its own citizens. The government borrows by issuing the government bonds and T-bills or treasury bills. It also includes the market borrowings by the government. The government bonds and T-bills are traded in the market, which is also known as gilt market. When government borrows from the domestic sources, the increase in inflation is less in comparison to simply printing the money. And therefore you can see that both the statements given here are correct. That is, a share of the household financial savings goes towards government borrowings. Dated securities issued at market-related rates in auctions form a large component of internal debt. So the answer is option C, both 1 and 2.
These answers are based on the various sources that I referred. If you find a different answer for any of these questions, please comment below. The next part will be uploaded soon. Stay tuned. Thank you.